Well, welcome to the EmployerNomics Strategic Partner Marketing Partner meeting. We used to do this every 2 weeks, but now only do it when we have something really special to talk about. And today we do have something really special to talk about. Michael Murray, our longtime strategic partner, co-conspirator, cigar aficionado, the driver of the rolling humidor, and also an expert on payroll and payroll matters, is here to talk to us about the employee retention tax credit. But before we get to that, let's go around and see who's here and tell us a little bit about yourself. Kyle, not everybody here knows you, and I know you don't know everybody. So you want to give like 30-second elevator pitch?
Yes, my name is Kyle Tenney. I am Will's nephew. I am one of the managers up at a company called Kamal Packaging in New York. It's my father's business, and I also am a part of Will's business, the Mid-York Press, as well.
Come to Kyle for your printing needs. Tessa is on a call right now, so I will introduce her for her. She is our intern from Valencia College, and she's doing great in the internship too, by the way. Dan, why don't you take us up to the third floor on the elevator? You're on.
Yeah, Dan Meistrick, Smart City. We're the newest telecommunications provider in Orlando. Our network runs throughout Orlando all the way out to the coast, bringing internet access, voice services, data services to businesses only for Orlando businesses, and saving money up against the Spectrum, AT&T, and Lumens. We do build fiber directly into everybody's business. We're not using anybody else's fiber. And that's me, Dan Meistrick at Smart City.
Glad you made it, Dan. Kathleen, do you have anything?
Good to be here.
You're good. She is the better half, the supreme commander of EmployerNomics, and obviously the decision maker extraordinaire. Just talking about that in class this morning, that we don't make any decisions without consulting each other. When I've done it without consulting her, there have been at times disastrous results. So just leave it there. So Michael, when did we first start talking? Was it 2006 somewhere?
I knew I was probably about 40 pounds lighter and had way more hair. That's what I do remember.
Likewise. I know that we've been talking for a long time. We were just email and telephone and forum conversationalists.
Yeah.
And finally, in 2016, we met. And when we were experimenting with franchises, you became a franchise of ours, although we're eliminating that and just calling them satellite offices now. But your company, PayrollMedics, has been someone we have been referring for payroll clients since 2000. I think you started in 2016, right? Or 15 or 16?
Probably, yeah.
Yeah.
Yeah, it's been a while.
So a lot of people have been asking about the ERC, the ERTC, or just the tax credit. And I gotta admit, there's a lot of mystery to it. I've enabled sharing, Michael. If you want to take over, you can start your presentation. But one thing I know is that if I need expertise on something involving payroll taxes, I'm going to call you. So with that, I give you Michael Murray.
Well, I appreciate it. So my company, PayrollMedics, we've been blessed and fortunate to help small and medium-sized businesses harness the power of this beautifully designed tax credit, meaning this might be the only thing that the federal government has done well and done right to actually lift up and assist the small business community across these great United States. What I like to do first is kind of kick off the warning signs of aggressive ERTC marketing. I'm sure many of us are getting pounded by social media ads, telephone calls, text messages about these large, high volume amounts of money that your business has qualified for. Please press 1 to speak to a specialist now. It has become so prolific and so bad and such a slippery slope that the IRS has taken an unusual step and they themselves are trying to push out warning signs to watch out for with these aggressive marketing from false promoters. One, unsolicited unsolicited calls or advertisements. We have to remember that in 2023, there's no such thing as free, easy, fast, and money in the same sentence. And unfortunately, a lot of small businesses still are falling for things like easy application, other employers that applied for or were approved for this credit, when in reality, there is no application process. Someone can help you determine your eligibility with a quick question on an employee, on a quick question of eligibility through a portal, or maybe a quick phone call with a specialist within minutes. Aggressive claims. Do you know your business can get up to $1 million, etc., without even discussing your specific situation, or overall just wildly aggressive suggestions from marketers. We have to remember that this tax credit is far from PPP, right? It is not free government money. This program is monitored, administered, managed, and heavily watched by your friends and mine at the Internal Revenue Service. And if anybody thinks they're going to get something over on the IRS, I would just suggest that you prepare to be audited. And so what we will do is jump right into the presentation. Let me pull up and make sure that I can actually share my screen. There we go. We're going to come in and we're going to do it. Let's go. Everybody can see my screen. Is that correct?
Yes.
Yes.
Okay, fantastic. Okay. So today we're going to discuss the employee retention tax credit. Primarily, we're going to look at who's at stake, who's eligible, how to file. Here's the big message that everybody has been hearing. Retroactive tax credits up to $5,000, up to $28,000. The big idea, the takeaway is, do you qualify? So what happened with the employee retention tax credit is it was simply designed to lessen the business impact of the COVID-19 effect with these credits. In short, the federal government wanted to reward employers who took great risks to keep their employees on payroll during a COVID period. The federal government now defines a COVID period from March 2020 to October 2021. So originally it was built into the CARES Act that was passed in 2020. At that time, many small businesses were focusing on securing their PPP and or those forgivable loans. The employee retention tax credit at that time was less well known. Some people believe that perhaps there was an attitude at that time of, should we trust the government? Is this program real? Does this tax credit exist? Compiled onto, there are many, many tax credits available to small businesses that the federal government has done a poor job in educating and or making available. So while everybody was in a fever for PPP, the employee retention tax credit was not as well known at that time in 2020. Originally, the refundable credit, it was available for employers who were impacted by the pandemic. Later on in this presentation, we'll talk about what impacted by the pandemic means to a small business. In short, it can be claimed when an eligible employer, eligible is key, when they file their quarterly federal employment tax returns. These rules have been amended twice, mainly due to transition of our administration from prior to current. Here's what's key. If you have questions about identifying qualified wages, calculating the credit, and filing returns, our or another professional experienced ERTC filing service can help. And of course, the requisite disclaimer, the content of this presentation is for informational purposes only and does not constitute legal or accounting advice. So what is the ERTC? Again, it was created to help small businesses to retain and who retained employees that were not able to work due to the COVID-19 government mandated shutdowns. Some of us had states, some of us had counties, some of us had cities. There were millions of small businesses that were negatively impacted, perhaps even terrorized by these government mandated shutdowns. The ERTC was introduced by the CARES Act and then amended by CAA, and then ultimately, once again, where we're at now, shaped by the American Rescue Plan Act. Today, though, more employers are and can qualify for this refundable and or advanceable credit. And here's the big idea, including those who previously received PPP and or loan forgiveness. The period of time that the ERTC covers. So there are different times, different years, different periods. Again, we want to think from March 13, 2020 through October 31, 2021. So in 2020, quarters 2, 3, and 4. In 2021, we want to look at quarters 1, 2, and 3, respectively. Right now, the big question on everyone's mind is, when will the program end? If we're qualifying for year 2020, those tax years, you have until April 15, 2024 to receive the tax credit. In 2021, your tax year is April 15, 2025. So it is still open. You can still apply. It is smart to apply as soon as possible because the IRS has been under bottleneck periods where they do have increased backlogs, primarily because they were underfunded, overworked, and overwhelmed. So what are those eligibility rules? You'll see here that this chart provides a very quick, high-level comparison of those eligibility requirements broken down for 2020 and 2021. The important part is what you want to look at is you can qualify either through government mandated shutdown and or loss of revenue. In a moment, we'll touch on those. The credit of how we get to these large numbers, $28,000, $1 million, etc., what some of the egregious promoters are referencing all the time are in 2020, you can receive 50% of, and here's the key, up to $10,000 of qualified wages for the entire year. So, for example, if a company has 50 employees and a large payroll versus a company that has 15 employees and a small payroll, those two companies will receive vastly different amounts of tax credits because it's based on payroll and payroll tax. In 2021, you can receive up to 70%, up to $10,000 of qualified wage each quarter. But the key is one of the tests are a decline in gross receipts. In 2020, you would have to have experienced a significant revenue loss, a negative impact into your business. And in 2021, it's a much more smaller or a minimal revenue decrease in order to qualify for the decline in gross receipts test. To be eligible for the ERTC, an employer must have actively carried on a trade or business. So you would have had to been actively involved in 2020 or 2021. Most businesses, except there's a term called a recovery startup business, but most businesses need to be able to show a negative impact from the pandemic. Either, here's the two-part test, a government mandated shutdown or a decline in gross receipts. A business only needs to be able to pass one test. The government order test. You must experience in at least one calendar quarter the operation of the trade or business is fully or partially suspended due to the calendar quarter from an order from an appropriate government authority limiting commerce, travel, or group meetings due to COVID-19. A broad way to think about this is, if it was not for the COVID-19 pandemic, my business would have been operating in a usual and customary way. Therefore, due to the COVID-19 pandemic, I can explain and or illustrate the government order test is a more of an honor test. There's no real factual. The Internal Revenue Service is not asking for substantiating evidence to provide government order. So many businesses are illustrating that if it was not due to the government COVID-19 pandemic, I would have operated my business normally. And due to the COVID-19 pandemic, I had disruptions in the following ways. That's how many businesses, in a real broad brush overview, are qualifying for government order. Many businesses are also qualifying for reduced gross receipts test, which is an employer experiences a significant decline in gross receipts, which includes, we want to think, sales revenue received, including PPP loan forgiveness. What the government is going to do is they're going to ask you for a baseline of the same quarter in 2019 as compared to 2020. So if you had a banner year in 2019 and a significant decrease in the same quarter in 2020, you would meet and therefore qualify under the gross receipts test. In 2020, the decline is defined as at least 50% in any calendar quarter when compared to the same quarter in 2019. Eligibility ends when the first quarter that follows the qualifying quarter, those gross receipts become greater than 80%. So the moment your revenue starts showing improvement, you are no longer qualifying for gross receipts or revenue decline. In 2021, the decline is defined as at least a 20% dip in any calendar quarter when compared to the same quarter in 2019. Most businesses find this a little challenging because many shutdown orders were lifted and we were getting back to a new normal in 2021. Gross receipts will be the primary means for eligibility in that year. Now, earlier we mentioned a recovery startup businesses. So those are businesses that began operations anytime after February 15, 2020. So those businesses typically have launched a business during the pandemic era. Those businesses do not have to meet either of the material impact test to be eligible for ERTC. They will generally automatically qualify, but they're only limited to 2 quarters in that period. The total credit for recovery startup cannot exceed $50,000 per quarter, and the business can only take the credit for quarter 3 and quarter 4 in 2021. This is a decision tree for 2020 quarters. So question 1 is, did government orders related to COVID-19 force you to fully or partially suspend business operations? If yes, did you employ 100 or less full-time workers? If yes, then in that quarter, did you employ or pay employees who did not provide any services? If yes, you are eligible. Or did you, when comparing the 2020 quarter to the same quarter in 2019, were gross receipts down more than 50%? If yes, eligible. So at PayrollMedics, we can provide a decision tree to help our business clients better determine a much more clear path to qualification. In 21, the decision tree is, was your business in operation prior to February 15, 2020? If yes, did government orders related to COVID-19 force you to fully or partially suspend business operations? If yes, did you employ 500 or less full-time workers? If yes, you're eligible. Or you may be eligible for ERTC as a recovery startup if, again, your business operations began after February 15, 2020. A few myths that are very popular where some people without examination will automatically decide that they are not, or their business is not eligible for this tax credit. The big, most popular common myth is we're not eligible due to receiving a PPP loan, or we did not get shut down by the government. There's a lot of misinformation and confusion. Some of us may remember during COVID, you were an essential business. So that's a common myth. We were not shut down by the government. Some people may not even want to attempt because they believe ERTC funds will run out soon. Again, this is not a PPP program. The government is not pouring money into a bucket for these funds. It is refundable tax credit based on payroll and or payroll tax. My CPA said I won't qualify. And again, I took the PPP loan. There's no way I can take the ERTC. Do we have any questions?
Oh, yeah,
I got one.
but go ahead, Dan, you go first.
Sorry, and thanks for this. This is great, Michael. Just curious, has there been any? So is there a bigger increase or a percentage of increase to getting an audit by applying for these loans? I guess has there been any? Is there the government gonna
These are
analyze these
credits, not loans.
businesses?
You mean credit?
Well,
Yeah.
I mean credit. I'm sorry, I mean credit.
Dan, and that's a great question. So, one part of the process where a lot of businesses get frustrated is that there's no instant gratification with this process, right? And so, average time frame today, let's say 16 to 20 weeks from submission to the IRS through the time where eligible business actually receives a check in hand. Part of what the Internal Revenue Service is doing is analyzing returns. Will there be audits? Absolutely. So we, what we want to think about from COVID is what has happened to PPP, right? That there were a lot of businesses that thought that this was unmonitored. It was a Wild West. Hey, let's just grab money. Nobody's paying attention. Almost every day we see that the government is once again teaching us a lesson that there are federal employees that may spend 37 years out of their career watching your business. Eventually they will catch up to the math. So those businesses that unfortunately obtained ERTC through an ERC mill, right? So meaning this, we have had people that we have said, hey, based on eligibility, based on the information you provide, we are not comfortable processing your tax credit because although we are not the judge, jury, and executioner, I'm of the opinion that you would not qualify, and I would not like to be attached to that in case you were audited, right? Because the unfortunate reality is everybody today who is taking advantage of this wonderfully amazing, powerful tax credit, receiving hundreds and hundreds of thousands of dollars 3-4 years later, when they're audited, they're going to forget the emotion of, I just want the money today. And so we are, PayrollMedics is simply a processor of ERTC. We are not able to give advice, meaning we have no idea to project what the Internal Revenue Service is going to say. We can only operate by eligibility guidelines. And so in those cases, those clients have turned around because they saw a Facebook ad, somebody called them, they got a text, they saw a pop-up shop on LinkedIn, and someone said, oh no, you can get money right now.
Right.
What's going to happen in those cases is the taxpayer is ultimately responsible. So if you don't have your ducks in a row, and you are standing out waving a red flag in front of the IRS, more than likely you're going to get audited. The IRS continues to publish information about that. Our advice is much like everything: dot your I's, cross your T's. Again, it's your business, it's your risk. If you want to roll the dice with an audit, um, ultimately that's your decision. Um, so it, it's going to be interesting in the next 36 to 60 months to see what actually happens and how in depth the IRS takes.
Yeah, I'm just curious about that because I know they put a lot of money towards IRS agents, and I'm sure some of that's going to there. So if you were to raise a flag saying, I'm going to get this money from the government, I'm sure you're going to be put on some kind of possible list. And in your experience, I mean, doing the work that you do, have you ever experienced anything like that? Businesses that take advantage of certain programs? Is there a higher level of auditing going on to those businesses?
So with ERTC, right? This isn't a situation of, oh no, we need to be afraid of the government. The government's going to come get me, right? um, what we want to look at is this, right? And this is where some people make a misstep. This is a refundable tax credit, meaning that prior to filing for this credit, a business has already provided information to the Internal Revenue Service, right? So a quarterly tax return at some point in time was previously remitted for a tax period in 2020 or 2021. In order to receive the tax credit, an amended tax credit is being supplied to the IRS. There is some scrutiny occurring at that time at the IRS. So, generally, if we're keeping our house in order, and generally, if our side of the street is clean, and our figures are true, clear, and transparent, right? Um, um,
You're good.
my suspicion you're going to be safe, right? But at any point in time, the Internal Revenue Service does conduct the right to take a business through an ERC audit to verify that the employer has actually and accurately calculated and claimed the credit um, in accordance with the provisions of the respectable act. But the big idea is this: the IRS has never said, if you claim this credit, you're going to get on our secret list, and that will automatically trigger an audit, right?
They never do say that though, do they, Michael?
I mean,
Yeah.
I'd like to find out if there is a secret list for sure, right? But I think what happens is this, right? Um, um, the reality is no matter if people want to point fingers at the government, um, we as human beings are going to be partly responsible for this cascading waterfall of IRS audits due to the fact that we continue to fall for false and shadowy aggressive marketing surrounding ERC claims, right? So the more businesses that are supplying the Internal Revenue Services with these maybe shaky, valid employer retention credit claims, that's going to increase the intensifying compliance work and putting in place additional procedures to deal with fraud in the program. And that therein lies the reality, right? It's sort of like the other day I went to Best Buy to purchase an electronic, right? And now we have to go through 19 hoops just to get a cable because why? People continue to shoplift, right? So in this thing is, what the IRS and small business groups and CPAs and payroll companies, one of the reasons that everybody's shouting from the rooftops is please, please, please be careful about aggressive marketing, is all it's going to do is create increased scrutiny for those of us that did good alongside of us that did bad.
Hmm. Dan, you
Thank
get
you.
your question answered?
Yeah, I did. Thank you.
Yeah, absolutely.
You answered 2 of my 3 questions. Before I answer my 3rd one, is there anybody else that has a question? Kyle, Kathleen?
Nope, I'm okay for the moment.
So one of the things you did say before we started this is that, and I think you just said it again, is that you want to make sure you're working with somebody who is going to be in business 4 to 5 years from now, if and when you get audited. Right?
Sure.
Because as we all
Yeah, for
know,
sure.
the IRS never audits you the day, you send in your return. It's always 4 or 5 years later when there's plenty of interest and penalties and fees. So I think it's important to be with someone who's established like PayrollMedics, to assist you with this, because I know you're not going anywhere. I know where you live.
Right. Yeah.
But-
Yeah, absolutely. Absolutely.
So I'm starting to wonder if we qualify for this after looking. I really liked that screen you put up with the flow chart. That,
Yeah.
if you would do me a favor, if you could send me that slide deck or just those
Be
2
happy to.
images, I would.
Yeah.
I'll send them out to everybody on this.
Yeah. Yeah, absolutely.
So the last question that I have, and I think I'm sure Dan wants to know this too, is what do you need from us minimum to even look to see if we're eligible or not? What documents? And do you need tax returns? What is it you need?
For sure. Yeah. So at minimum, you would want to gather the original tax returns that are filed with Internal Revenue Service. So a quarterly Form 941, and or depending on what state you're in, a reemployment Florida or a standard unemployment state tax return, combined with what the business believes they're going to qualify on. So, for example, if it is a decline in revenue, you would want a some type of illustration, which could be, hey, in 2019, here's the 3 quarters, this was my revenue, in 2020, 2021, etc. And so you may have a spreadsheet showing that decline. Um, uh, so ultimately, right, it goes back to, if that's what you choose to do, just remember, if you were to get audited, that's when you want to be able to show clear financials. In order to qualify, we do not ask for those financials.
So to that fact, so you're applying for this. The government has all that information. You're filing with them. There's no easier way to say, listen, here's my business ID. This is my and it's a revenue. I'm justifying this on a revenue downturn because of COVID, whether it be all the myriad of things that COVID adjusted, not just they shut down my business, but supply chain, et cetera, and so forth. There's not a portal or something that you can stick the business in there and say, okay, here's the revenues. You have to support that by giving them a spreadsheet.
Dan, what you're asking and or making the assumption is, A, the IRS cares enough about you and your business to help, right? Which is not the case. We have to remember that the Internal Revenue Service, their sole and primary function is the collections arm for the United States of America, right? They are the heavy. They are the sharks, right? They are simply there for accounting and collection. They are not there to serve the people. Number 2, in 2023, the Internal Revenue Service, at best, their technology are 2 pieces. The fax machine, for those of you that were born in that era, and or the IRS relies on another amazingly efficient government entity to help us communicate and transmit valuable information, the United States Postal Service. The Internal Revenue Service will not accept perhaps more efficient ways to communicate, like Federal Express. So it is postal
Yeah.
mail and fax and or telephone. And that's why you want to go through some type of a trusted and experienced advisor, because it's a process for sure.
So, and further to answer your question, Dan, is like, yes, does the IRS have all the data he mentioned? No, the IRS only gets the 941 and the 940. They don't get the state unemployment, the
Yeah.
ones with the federal quarter. They don't get the state quarterlies, and the state doesn't get the federal quarterly. So we're dealing with different branches. So I imagine, and then of course we got to come up with our rationale for why we are eligible. So
That's absolutely correct. So
Yeah.
the IRS is never going to take a position, right?
Mm.
And where a lot of businesses, I think, get confused is why CPA, why PayrollMedics, why the IRS? Because the reality is nobody but you operated your business. Nobody but you were involved in your business during the COVID period. At best, if I were to determine if your business was eligible, at best, it's perhaps an educated guesstimate.
Which brings me up to my final question. If anybody else has a question, is, and you're gonna love this one, Michael. Some of us don't do our own payroll. In fact, some of us don't even have our own employees. For
Correct.
example, EmployerNomics, our employees are all employees of Coastal Group, which is a staffing company doing an EOR.
Correct.
How do can we get our, I know we can't get our 941s or 940s, but can we get an equivalent from them, which the IRS would accept?
So in that case, whether it's staffing or a
PEO.
professional employer organization / employee leasing, the easiest way to kind of look at that is depending if they are a certified PEO or not. A business is going to have much better success with a certified PEO than a non-certified PEO. And or in the case of a staffing or an EOR arrangement, the question would be, how are my 941s filed? Because if they're not filed in a master or an aggregate way, meaning that you may have an opportunity, they potentially could be filed outside of that entity's EIN. You would likely be able to secure those, and or if it's not a certified PEO, you may be able to have some success in working directly with the Internal Revenue Service, or in some cases, find out if the provider themselves have already filed on your behalf. They may have, and you may have access to funds that you didn't know were filed on your behalf if they are filing aggregately. So those would be the couple of things that I would suggest.
So you bring me up to part 3 of my question. If they've already filed and received the tax credit and they didn't give it to us,
Correct.
is there a recourse for us? I mean, or do we have to sue them?
So that would fall into the language of the respective client service agreement.
Okay.
And then looking back at IRS guidelines, again, if they were a certified PEO, I would say you have much greater success. But ultimately, if a vendor filed aggregate, and it was discovered that tax credit was received, and the business did not receive it, I would suggest that someone picks up a telephone and has a conversation with Internal Revenue Service, which may provide leverage to motivate that entity to pass on that tax credit back to you, the employer. It's a gray area with a lot of questions for sure.
Because we've actually had a client come to us and say, hey, I want my ERTC, and he went to his PEO and they said, you're not entitled to it.
Correct.
Also gotten the PPP loan, and I mistakenly told him that, well, if you got the PPP, you can't get the ERTC because
Mhm.
I believe one of those rumors. I
Yeah,
didn't
for sure.
realize that had been changed. So, okay, so that's good to know. Is that, like you said, the certified PEOs are probably already issuing credits to their clients. So I'm going to look into that because I have a feeling we might be eligible for the small part of it.
Yeah, for sure.
Very informative.
Yeah, mainly with a certified PEO, they're going to be um, more, I would say, yoked um, or in alignment with the IRS. Obviously, they have tremendous benefits with their designated certification. Um, so I just think that any employer that might be utilizing a PEO or a CPO, a CPEO, or really any third party service provider who believes they're eligible to claim the ERC through that third party payer, we have to remember that even if it's a PEO, they would have had to file some type of an amended 941, or in the PEO world, it might be called a Schedule R for those applicable quarters that impact their client customers, right? As a PEO client, you may request or discover, do they have that amended 941 or the Schedule R for those quarters? Also, a great question to ask would be, did the PEO file on the client's behalf a form 7200-7200, which claims in advance or states a reduction of current or forecasted payroll tax obligations related to quarters specifically ending in 2020. So it's important to remember that, yeah, the ERC is going to have specific qualifications placed on employers, and under the guidance issued by the Internal Revenue Service, a PEO, CPEO, or third party must collect any information from the client customer necessary to accurately claim ERC on their behalf, for sure.
All right, so that sounds like something we need to just go look at our client service.
Yeah.
Yeah.
Mhm. Yeah, that's a good place. And then pick up the phone, see if your client service representative and or the someone in the tax department at the PEO can answer those questions, um, and find out that there may be a filing window that's still eligible, but it's always worth a conversation for sure.
Yeah. Well, this has been great. Like, I've learned a ton. Before I stop the recording, are there any final questions? Okay, so we're going to go to unofficial mode now. For those of you who are watching the recording, sorry you couldn't join us. I hope you're enjoying this recording. We all learned a lot from Michael today.